But now we're going to get some insights on the news that's shaping markets. For that, we're going to welcome in our next guest. Joining us is Jeffrey Small, the managing partner at the Retirement Income Source. Jeffrey, thank you for being with us right now. You know, I'd love to just start sort of piggybacking off of this NVIDIA discussion I was just having with Kevin and this AI boom. You know, do you think that the current boom we're seeing is sustainable?
Well, if the tech isn't ready, why are companies spending trillions of dollars? I mean, really, no one wants to miss the future. That's why. And so right now, AI powered equals stock pump. The AI strategy is the new code for dot-com-esque. And so AI is added to everything to keep investors happy today. And so what really hinges on all this optimism is, can big tech, the mega cap tech, deliver on earnings? That's the critical component here.
So if that's the critical component, what concerns do you have about a bubble? Because you also mentioned .com in there, and we know eventually that one burst.
Well, we know AI is transformative, right? But remember, bubbles only happen when hype outpaces fundamentals. And so there's two things that will cause a pullback here. The fundamentals don't materialize into the investment, or spending will start to peak and fall off, and that will cause a correction. And so, the reality is we have to be concerned about valuations here. The market is in a manic phase and mania right now, full effect, in my opinion. We've got a lot of companies in the AI ecosystem that are way above the traditional multiples. I mean, Palantir is at 500 times earnings. I mean, that's very dot-com-esque. And so, looking historically, though, at the S&P 500 valuations, we're at the same price to earnings ratios that we were in February of 98 and July of 03, even though the market capitulated and started to climb back up after March of 03. And so I can say that we're in a 1998 moment here pretty confidently, based on our fundamentals going to improve and/or will spending begin to pull back.
All right, and I want to talk about something that you mentioned because I think it's really interesting. It's a name we talk about a lot, but in part because it's not a publicly traded company. You say that the market right now is tied to the success of one company. Will you tell us what company it is and why you think that?
Well, really, the entire ecosystem of AI is contingent upon OpenAI, which is generating about $13 billion a year in revenue, but has $1.5 trillion of commitments. That's a very lopsided amount of investing based on the amount of revenue. And so maybe it takes 10, 15, 20 years for this to materialize, but everybody's jumping on the bandwagon because they don't want to get left behind. And so also inside that infrastructure, you have the 10 largest mega cap big tech stocks dominating the landscape of investment in OpenAI and ChatGPT. And so that is a bet that they're willing to make that's going to deliver on fundamentals. But at some point, even that reinvestment will start to curtail as investors will say, hey, where are the returns? And by the way, Wall Street will say the same thing. Where are the fundamentals being impacted here? And is there going to be significant improvement? And so, I prefer to buy companies today that are accessing the AI side of the equation, but already have really good fundamentals. And I think that's going to be critical for investors to avoid this bubble if it does burst at some point.
I want to get to your picks in just a moment, but about OpenAI, if they stumble or we see a delay in their profitability, how much contagion risk is there for the broader market?
I think the contagion risk is very large inside the AI ecosystem of companies that are publicly traded. Number one, NVIDIA, they're 8%, 8.5% of the market cap of the S&P. The Mag 7 is 35% of the market cap of the S&P. We are significantly overconcentrated. And if the house of cards starts to fall in that category, it will affect the broader market. But the broader market is technically more overvalued than the Mag 7 stocks today.
Okay, so with your picks, you said you like to invest in people who are profitable right now. Who are some of your picks?
Well, out of the Mag 7, I really like Meta a lot because of their fundamentals, and I really like Google a lot because of their fundamentals. They are considered hyperscalers. They're investing, hundreds of billions of dollars in AI, and they should because they don't want to get left behind. I also love NVIDIA. NVIDIA's a great pick at this stage. They're going to keep growing as the demand keeps growing for AI and the reinvestment. They're going to be here. These companies, to me, are undervalued compared to where they really should be based on their growth rates. And so at this time, I think those are still good bets to buy the dips and buy the lows. Now we have a buying opportunity. And, back in April when I was on your show, I basically told everybody that, we may never see these stocks this low ever again. And that was in the middle of the tariff collapse, that little black swan, mini black swan that we had on April 8th low. And so we may never see stock prices this low again on these companies as they grow and mature and continue to develop their fundamentals.
And Jeffrey, I'm noticing that you don't have any cloud providers. I guess Alphabet, we can make an argument, as a cloud provider in your 4 picks. As far as the engines in this boom, do they win no matter who wins, or are they also exposed to a potential downturn here?
Well, they're obviously exposed to a potential downturn. The Microsofts, the Amazons. I love those companies. How many picks can I have on the show? Okay, those are great picks. But the big cloud companies, including Google, those three, they do have exposure, but they're building for the future. And you have to remember, those companies already have incredibly solid fundamentals and an ecosystem of business revenue that's not codependent on the failure or success of AI. So they can afford with their free cash flow to reinvest into those things. And I think it's the hyperscalers are doing the most because they'll get the most benefit on the fundamental side in the short term as this AI story and everything powered AI develops.
And so, Jeffrey, how does someone invest intelligently in this environment where you've described there's a mania and we're seeing hype and fundamentals basically colliding?
Well, I really kind of just described it. For the last 2 years in all my media appearances, I've been screaming about Google and Alphabet and, Microsoft and Nvidia, and people just they didn't get it. The rest of the Wall Streeters and prognosticators on the networks are basically saying, oh, for January of 2025, the Mag 7 they're not going to do what they should be doing this year. But look what just happened in the most recent quarter, 26% year earnings growth year over year versus the broader market, 6% earnings growth. And so we expect that trend to continue. So the answer to your question is investors need to buy companies that have double-digit revenue growth. And those will become value stocks if AI becomes a bust.
Jeffrey, we appreciate you taking the time to talk AI with us this morning. That's Jeffrey Small, the managing partner at the Retirement Income Source.